The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Everything that was working right for the stock market now seems to be working against it. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. and the market internals today. Very interesting. You can see that this S&P 500 well off its worst levels of the session, still down by about 0.2%. It's really big tech that is the weight here, and you can see that in the NASDAQ 100 off by about 0.5% right now. Take a look at the Russell 2000, the small caps. Actually, your big outperformer today, higher by about 0.8% if you're feeling optimistic. So the little guys really punching above their weight. And Bitcoin, too, even finding a bid, a small one, but still relative to the past couple days, not too bad. Bitcoin up by about 1.5%, Romaine.
Yeah, that chart really does show the dip buyers doing their best here to kind of lift this market, particularly with the S&P trying to avoid a fourth straight day of losses. But we should point out that technical damage underneath the surface, that may be a little bit too much to push back against. The S&P, remember, is only down just about 3% below its record high from October 28th, but you have about half of the index members below that 200-day moving average, and the technical lines, they're not looking good here as we move into tomorrow. Tomorrow is big. The stakes have been raised. That might actually be an understatement heading into those Nvidia earnings after the bell tomorrow. It doesn't help that JP Morgan Vice Chair Dan Pinto says AI industry valuations are due for a reassessment. It certainly doesn't help that Redburn analyst Alexander Heisel downgraded Microsoft and Amazon for the first time in 3 years, citing what he calls an increasingly misplaced narrative on AI investments. It also doesn't help that a smattering of employment reports today showed deterioration in the labor market, and it doesn't help that Home Depot cut its earnings guidance because of consumers hitting the pause on big-ticket purchases. And, of course, sentiment and market momentum that had already been fading, evidenced by the breakdown in Bitcoin, which today traded below 90 grand for the first time, Katie, since April.
Yeah, now trying to find a bid. But let's talk about the bond market here, because it certainly doesn't help to add to Romaine's list that you're seeing those Fed cut bets really get pared back. And you can see that in the blue line here on this chart. That is your market implied Fed rate decision, or Fed rate after the December decision, which is coming up in just a couple of weeks. You can see that that line has been going higher as traders have really pared back their expectations from what we might see in the way of rate cuts coming next month. But then you take a look at the 2-year Treasury yield. Typically, these two lines are married. They love to stay together, but we've seen them break apart a little bit. The 2-year Treasury yield hasn't risen as much as you might expect when you take a look at that market implied rate, Romaine. Don't know really what to make of it, but it also just speaks to all of the confusion that's out there as traders try to figure out what to make of valuations and what to make of this Federal Reserve.
Well, let's kick things off to the close with Kai Haigh, co-head and co-CIO of Fixed Income and Liquidity Solutions at Goldman Sachs Asset Management. Kai, it's been a wild couple of weeks here, and I'm not sure what to make of it, whether we're just talking about a market trying to come to terms with whatever the reality is, whether we're seeing profit taking in equities. But when you look at what the bond market has done, or rather it hasn't done, I am curious as to what is actually being priced in, at least when it comes to treasuries.
Great. Well, thanks for having me. Yeah. Look, you're right. Of course, the bond market has operated in a bit of a vacuum for quite some time now. That vacuum is the lack of data. We're going to get a little bit more guidance as we go through the week. And I think the market is really, really waiting for that. The last data point the market really had were comments by the Fed chairman. It took the certainty of a cut in December off the table. Mm-hmm. It now becomes very data dependent. And the data that really matters is the labor market. And from that point of view, I think we will get some guidance as to what December might hold.
I am curious then. I mean, we talk about the next meeting just something like 3 weeks away here. Yeah. I know the data coming out now is just very sort of bifurcated. Yeah. And I mean, you have ADP numbers, you have obviously the delayed jobless claims numbers and the monthly government numbers, but they all do seem to point to deterioration in the labor market to some extent. Do you think Jay Powell might have been premature in his last press conference in saying that the Fed would basically be on pause for the December meeting?
Well, I think the emphasis was much more on the fact that it was data dependent rather than on pause. I think the market had priced with some degree of certainty a December cut. And I think what the chairman tried to do was just to emphasize it's data dependent. We will get that data. Right now, the market price is a 40% chance of a cut. We'll see how that evolves. That's obviously the short end. There's obviously other pressures on the yield curve that are at play at the moment. Fiscal is part of that. Inflation is another part of that. So it's not just the labor market. There's a lot of data to work through.
Absolutely. And Kay, I really want to take this conversation to the corporate credit market, because what we're seeing in the stock market, maybe you're starting to see it translate a little bit into the credit markets as well. Great story on the terminal talking about risk premiums on investment grade, on junk bonds, hovering near their highest levels in weeks. We're not talking panic levels or anything close, but I'm wondering if we could see those sort of measures of uncertainty start to build as the weeks progress.
Well, we've seen a little bit of the beginning of that. I mean, put some context around it. Like, valuations had been tied, historically tied, for quite some period of time. That's one part of the story. There's obviously a set of fundamentals that supported at least some degree of tightening. If you look at the corporate sector, particularly in the United States, it's been strong. It's not over-leveraged. There's earnings growth. If you look outside of the United States, if you look at Europe, there's been fiscal expansion in Europe. So there are quite a number of good reasons for why spread should be tight. But they are at an all-time tight level, which makes it very, very hard for fresh investors to come in and be very aggressive about the market. So if you see the volatility now in equities, clearly it will feed through a little bit into price action into the credit markets. That doesn't mean that the credit market is going to be under significant pressure permanently. Right.
And I wonder what this means for borrowers. You mentioned this potential pressure when it comes to fresh investors, but you take a look at what happened with Amazon's $15 billion note sale yesterday. Originally, they garnered about $80 billion in orders. When what pricing was finally revealed, that figure fell closer to $47 billion, still oversubscribed by quite a bit. But you think of all this fresh debt coming into the market. Could investors be a little bit choosier about what they actually bid on?
I think what investors are learning actually at this point is that, doing their homework and looking at the fundamentals is becoming increasingly important. We've had a flood of money coming into the market, new issues. They've all done very, very well. But with the pressure that is building in the market, investors are becoming much more discerning as to what they want to buy and where they want to put fresh money to work. And I think that's just another case of why you want to look a little bit more actively and dynamically at the risk that you're running within fixed income portfolios, actually.
But I'm curious, when you hear some of the comments from JP Morgan's vice chair about a reassessment of AI valuations, and obviously he's talking a little bit more about equity valuations, but given that we're starting to see those two worlds collide when it comes to AI and a lot of the borrowing, as Katie referred to, I'm just curious what a reassessment actually means. Are we talking about a meaningful correction of some kind, or just the idea that investors will just hold back until they get more clarity from these companies as to what the return on this investment is?
Well, investors will look at what the potential downside is. And I think the downside can differ significantly depending on what names you look at. So if you do get issuance and it's backed by cash flow and cash generation, I think investors will look at that a little bit more positively than other types of issuance. So you get this at these kind of spread levels in the market, like the investor base becomes much more willing to separate between the different stories. And I think we're beginning to see that. Doesn't mean we're going to have a wholesale reevaluation of AI, particularly not in fixed income. But people are trying to figure out who the winners and losers might be over time. And that's natural. That's healthy, actually.
Yeah.
Okay, we have less than a minute left here, but I'm taking a look at the notes that you sent over to our producers. You mentioned that risks include AI-related debt issuance. We're already talking about it, but just directly, what is the risk there?
I think the risk is that, like, investors back a business model that they don't fully understand, that they back it at the wrong kind of spread levels where they don't get compensated for the downside. So again, I think it's a new area, and I think investors have to become familiar with what they are buying, and we're going through that process.
All right, really appreciate you taking time for us. Haigh there, co-head and co-CIO of Fixed Income and Liquidity Solutions at Goldman Sachs Asset Management, as we count you down to the close with a reassessment of valuations and a reassessment of economic conditions. We're going to discuss the state of the freight market. The CEO of RXO, Drew Wilkerson, will break down what his latest findings show. That's coming up next here on The Close. This is Bloomberg.
Freight broker RXO out with its truckload market forecast for the fourth quarter, tracking the tailwinds and the pressures facing U.S. logistic companies. The latest data suggesting 2026 could mark a, quote, meaningful shift in truckload market dynamics as a supply-demand squeeze takes hold. Joining us exclusively on the heels of that report is RXO CEO Drew Wilkerson. Drew, great to have you with us. So for those who aren't very well versed in, of course, what's going on in truckload dynamics, talk us through the shift that you see occurring potentially in 2026.
If you look at what's going on right now as we're ending 2025, heading into 2026, you're seeing a big structural change in the capacity side of our industry. Right now, based off of English language proficiency and non-domicile drivers, we've seen a lot of capacity exit. And I'm seeing something that I haven't seen in my 20 years of doing this. Typically, when demand is down, which if you look right now, based off of cash freight index, demand is down 7% on a year-over-year basis. You see tender rejections during that time go down. But because the amount of capacity that has exited the market, you're actually seeing tender rejections go up. So what we're working our way towards is a supply-driven inflection. And if you start to get a little bit of demand that comes back in 2026, it sets up for a good run for us.
And Drew, just to make sure I'm understanding, so are you saying that you don't see that capacity necessarily returning to the industry?
At this point, we have not seen any of it come back in. It's something that we're watching every single week, and we pay close attention to what's going on. But longer term, this is good for large, financially stable providers who have good technology, have good relationships with their customers, who have a history of vetting carriers that they're working with, because those carriers are representing customers when they're out there.
So then, Drew, what does that mean, like heading into 2026? So let's take the holiday season out of the equation. We're in 2026 going forward here. So how do sort of, your procurement folk, executives and other folks, how do they adjust to that reality for 2026?
Well, you're dealing with a lot less carriers. And, by some estimates, you're talking about overall upwards of 10% of capacity that is coming out of the market. So if you look right now and you go off the numbers that I told you, where cash freight index on demand side is down 7. If you look at the Sonar data, it tells you that your full truckload contract volume loads are down 17%. If you start to get to just back and normalized of where you were at on a year-over-year basis, you're at a point where you don't have enough capacity, and that's where you start to see rates go up. And during that time, that's when customers lean in on who they trust, who's delivered for them on the past, and who has that capacity for them.
I do want to get your thoughts, Drew, just on the inflationary environment that we've been in. Obviously, we talk a lot about from the perspective of the consumer, but there's also been a lot of cost pressures on the carriers as well.
Yeah, if you look at what's happened right now, just take the operating costs. Right now, if you look at rates, they're basically in line with what happened in 2014. But operating costs, what it costs to run a truck, is up 34% during that time. So for your average trucker, there's not a lot. So even before English language proficiency and non-domicile drivers, you were seeing capacity come out of the market because it was hitting a point from a rate perspective where truckers couldn't make money in this market.
And Drew, I want to talk a little bit about AI and what RXO is doing there, because I'm taking a look at a report from Morgan Stanley actually in the past week, raising your stock to overweight. The reason why is that they also see an inflection coming next year, but particularly when it comes to AI productivity. And they write that RXO can be amongst the leaders in the deployment of AI. And I'm curious, what does that actually look like as you start to send AI out and incorporate it into your workforce? Tangibly, what does that mean?
Yeah, so we've been one of the leaders on the transportation side from a technology perspective for a very long time. All of our systems have been homegrown, built from the ground up. But when it comes to AI, it's changing the game and it's changing how we do things. If you take our last mile business, when you're talking about installation of big and bulky goods, we would take a picture and it used to go to a person who verified that. Now it actually goes to one of our agentic agents who can verify that the installation was done properly. When you think about things like check calls, tracking loads, back office work, all of that can be done by agentic AI bots for us on this side of it. From a pricing perspective, we've been a leader at being able to adjust in real time what's going on in the market. And we're using AI to continue to evolve on the pricing side and get better and get faster. And with every load that goes through our system, the system gets smarter. So longer term, if you look at the brokerage industry, typically at the bottom of the cycle, which is where we've been, EBITDA margins are low single digits. At a midpoint in the cycle, it's mid-single digits. During the up part of the cycle, it can be high single digits or even low double digits. And based off of what we're doing, we expect AI to have a 1 to 2 point percentage impact on our business during all parts of the cycle.
All right, Drew, always great to catch up with you, always illuminating not only about the state of the freight industry, but of course the read through to the broader economy. That's Drew Wilkerson, the CEO of RXO. All right, coming up here, we continue to track the pressures in the economic landscape from tariffs to supply chain constraints. We had a chance to catch up with Daymond John, the CEO of FUBU, and Kerim Kfuri, the CEO of the Atlas Networks, one of the premier supply chain experts in the world. That's coming up next here on The Close on Bloomberg. Catch up with the legendary investor and entrepreneur Daymond John, of course, of FUBU fame and Shark Tank alum. His associate, Kerim Kfuri, is the CEO of the Atlas Network. He is the go-to supply chain guy for Daymond John, and together they gave us insight into how brands can manage some of the disruptions we've seen in that space. Take a listen as to what they had to say.
The most successful product in all of Shark Tanks, if you see my underachiever fellow sharks, just remind them, is Bombas socks. My investment, it's socks. You don't know, it's usually, it always is very honest, the entrepreneur, and then you back into how they're making good, manufacturing it, delivering it, and then you go into the numbers.
Of course, one of the biggest challenges with these consumer types of products is obviously sourcing the materials and the other supplies that you need to make, package, and ship those things out. And I guess that's where Kerim comes in with a lifetime of experience in that area. And I am curious, not so much as to what kind of advice you give Daymond and other entrepreneurs, but how much you've had to change that advice over the years as things like tariffs and geopolitical issues have kind of shifted what the supply chain is.
Sure. I mean, the supply chain is the most consistent, inconsistent market you could ever think of. The only consistency is inconsistency. And the problem is that you have this mixture of controllable and uncontrollable factors. And the only way to really be disruption-proof is to be nimble and adept and agile and have plan B, C, D, and E. Because in the end, if the supply chain can't deliver who is the ultimate consumer or customer, it breaks down all the way back. So whether we're talking about a pandemic or we're talking about tariffs or a strike at the ports, whatever it may be, the ultimate fulfillment is to the customer at the end. So the strategies that we always have to look at are really industry by industry, product by product to determine how to manage these things.
Well, you mentioned the pandemic, and this is something I always wonder about when it comes to conversations about supply chains, whether or not the experience with the pandemic made supply chains maybe more resilient, maybe a little bit more flexible than they would have been otherwise heading into this tariff shock, or whether we're talking about two entirely different set of circumstances.
Ultimately, we should have learned a lot more, I think, as it comes to the global supply chain. But, you know, hindsight's always 20/20. And, you know, as soon as things calmed down, everybody just kind of turned their attention to what was most in front of them. And in doing so, you lose some of those fundamentals and those ideas, which is how to be robust, how to be resilient, how to have your alternatives in place. And that ends up being the biggest level of disruption because you have all your eggs in one basket and things change. And then how do you basically accommodate those changes? So I would suggest, and we always are talking to our companies and brands that we speak to about what are you going to do if there's no product available? What are you going to do if your costs increase significantly or if your supplier just can't deliver anymore? Do you have those plans in place? And anybody who has a strong supply chain has a diverse supply chain, regardless of what we're talking about, whether it's a pandemic or it's tariffs or whatever it may be. The diversity of the supply chain is going to be the key to success.
Well, Daymond, bring us into the lived experiences of some of these companies, some of these brands. You know, when you're talking to founders, what industries tend to be disproportionately impacted by what we're talking about?
Well, anything that you need several different aspects and several different components. You know, listen, when I first started, I was making in Guatemala and then I was making in Korea. That shifted over to China, but then China, these factories are opening and closing just as fast. They're owned by the government, right? Then I moved over to Turkey and India. So if you're having different components, right? And so that's why, you know, I had reached out to find somebody like a Kerim. I actually found Kerim, because I don't have time to deal with all that, right? And that's the problem when you are somebody who's building a brand. You start a brand and you want to solve a problem or bring somebody joy, but all of a sudden now you have to learn manufacturing, shipping, finance, social media, and all this other stuff. So again, somebody that like Kerim, who has 2,000 factories at their fingertips, are the ones that you want to go to, because there is no one answer. And tariffs, quota, it's illegal to make a product over here, government change, war, it's all over the place.
I mean, one interesting thing that's come out of this, though, Kerim, and we talked a lot about this on this show back during the pandemic when all the supply chains basically got disrupted, was this idea that companies now and executives had to really start to think a lot harder about the supply chain.
Yes.
And to a certain extent, it almost ended up being a silver lining, as companies that never really thought about it, all of a sudden we're finding ways to innovate, finding ways to be more creative. Has that stuck?
Yes, I do believe it's stuck, and I believe that we're creating more and more best practices. And how we see that isn't just with businesses, but even at the level of education. Look at how many universities now are offering supply chain management degrees and master's programs, so on. We have generations of supply chain professionals that are learning from the issues of the past.
Daymond, I'm really curious what you're seeing on the consumer level. We keep talking about how prices, maybe the rate of change is slowing down, but absolute price is very sticky. What are you seeing when it comes to consumer health, especially as we head into the holidays?
Well, you know, we saw a shift where you can buy things directly from the maker. At the end of the day, now when you're buying it overseas, you're getting, you know, 20, 30, 50% increase. But if you're dealing with big box stores and various, they say, I'm not selling this to my consumer more than $9.99. That's your problem. And if you don't want to do it, I'm going to find somebody else who's going to do it cheaper with a bigger smile. So they don't want to pass that on to the consumer at the end of the day when you're dealing directly with big box retailers or retailers in general.
And our thanks, of course, to Daymond John. He is the CEO of FUBU, and Kerim Kfuri, the CEO of the Atlas Networks. Really interesting conversation, and I love the socks.
Yeah, I mean, the Bombas. I mean, it's funny because, I mean, we all kind of associate him with FUBU, which kind of is a big brand back in the day, but Bombas is like, Bloomberg just did a whole story about that.
I know.
mean, 500, tracking to 500 million in sales. This was a Shark Tank pitch from years ago. He took like a 17, 18% stake, which I think got renegotiated at some point. I don't remember what the initial investment was, but I assume it was a lot less than $500 million. So.
Yeah, that's true. And I like that story, too, because they talked about maybe they were going to expand into other categories, but the socks are doing so well.
Socks,
so maybe they'll just stay there.
Everyone needs socks.
You can't replace socks with a robot. Coming up, we'll talk to someone who sits on the boards of Coca-Cola, Disney, and Under Armour. Her name is Carolyn Everson. That conversation up next. This is The Close.
It's possible there is probably a correction there. And that correction will also create a correction in the rest of the segments in the S&P and in the industry, because you are probably, in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing.
Daniel Pinto, the JP Morgan Vice Chair, speaking at the Bloomberg Africa Summit hours ago. It is 3:30 p.m. here in New York, and this is the Countdown to the Close. I'm Romaine Bostic.
And I'm Katie Greifeld. Of course, a really interesting conversation about the possible correction that's coming in AI valuations. Just one of the many questions there is at this moment about AI and what the future looks like. So let's keep this conversation going now with Carolyn Everson. She sits on the board of the Coca-Cola Company, the Walt Disney Company, and Under Armour. She's also a senior advisor over at Permira. Carolyn, great to see you in person.
Thank you for having me. It's great to be here.
So you have such a unique perspective, of course, on how AI is shaping companies. And there's a great piece in the Wall Street Journal coming out of their Leadership Institute. I understand that you attended as well, but it seems like the consensus is that, okay, AI is fueling change faster than anything we've experienced before, but how exactly companies handle that is not as clear. So I wonder, you know, in the chairs that you occupy, what do those conversations sound like?
Well, you can count on the fact that AI is a topic at every single board meeting. It's been about 3 years since ChatGPT arrived on the scene, and I think the last 3 years have been a lot of experimentation at most companies. BCG just put out a recent survey that said 5% of companies are actually seeing the impact of AI in their P&L. and yet well over 65% of companies are reporting AI initiatives. So I do believe 2026 is going to be a year where it's going to materialize in companies' P&L, both on the cost and efficiency side, as well as on the revenue growth. A few factors companies are really working through. One is how to upskill and really completely retrain their workforce on the utilization of AI. And you will see a dispersion of companies doing that really well, where all of their employees are utilizing the tools and getting more comfortable, and those that are perhaps lagging behind. So training and change management are number one. And then the second is really this move from, do you have an AI strategy, which was kind of the buzz question for the last 3 years, to what is your strategy in an AI world? Because everything should change. Every single function, every workflow needs to be reimagined. Business moats and competition will change. So it's a very important and key topic in boardrooms.
Yeah, and those are two very different questions, too. So getting answers to that has to be interesting. But you touched on this a little bit. But when it comes to the P&L, how this is actually impacting companies, something I wonder about all the time is whether we're just talking about productivity, whether we're talking about cost savings chiefly, or whether we're talking about actually reaching new customers or unlocking, new lines of business.
Well, I think those are the two vectors. You're exactly right. So we are, and every company should be looking at how to make everything more efficient, either with less people or to be able to produce more. But the more exciting opportunity for AI is actually generating new revenue streams and reaching new consumers. And there's been incredible progress with AI in marketing. So companies like Coca-Cola are reimagining their entire workflow in marketing, which will allow them to get much more targeted in terms of the right messages to the right consumers. We've been talking about that my entire career in digital.
Are those marketing campaigns going to resonate the same way? I know there's been a lot of everyone's seen these Coca-Cola ads, and there's a new ad, I think, with Ford, a car company, that also use all AI. And I am just curious, is there a sense that that is going to resonate with customers in the same way that filming that with humans, particularly for Coca-Cola, which always has, particularly around the holidays, kind of these real touchy-feely, make you feel warm in your belly kind of ads?
Oh, it's a great question. So with Coca-Cola, I would say Disney is the exact same way. This is about human involvement really being enhanced with AI. It's not AI replacing humans. So there were humans extremely involved in that Coca-Cola holiday campaign. As a matter of fact, the song is being sung by real humans. So even though a lot was done from an image standpoint utilizing AI and translation into different languages to make it appropriate for geographies, the human element is critical. I would argue that actual humans and how they're going to touch all of these campaigns will be more important than ever before, because brands need to resonate more than they've ever before. Consumers used to be able to now search and scroll through a doomsday list of blue links in order to find either a company or product or service they were looking for. Now, instead of search and scroll, it's ask and get. And 20% of purchase decisions in LLMs are being driven by LLMs, I should say. That means brands need to be discovered in LLMs, which means the human element and the emotional resonance of brands is going to be more important than ever.
There is a broader issue here, too, about the idea of replacing humans, whether it's in ads or movies, but also just in terms of employees. You talk about living in an AI world. Senator Mark Warner from Virginia made some comments yesterday, this idea that he wants some of these companies to take whatever they're saving from AI and reinvest some of that in job training, with the idea that there will be a lot of workers displaced as AI technology does broaden out to pretty much every facet of our lives.
So I think the way most companies that I'm involved in are thinking about this is, how do we utilize AI to take out the monotonous tasks, the tasks that really don't need to eventually be done by humans, because they would be better served by AI agents. But that should free up the talent to do things that are much more value accretive to companies, that are much more creative. And is in many cases, actually, there's a talent war for new talent coming into companies that have what I would call AI native or AI real skills coming in. And I know I've seen the data that, for younger people coming out of college, the job market has been very, very difficult. And I think we're in this little bit of a bridge, because the next generation coming in, give it a few more years, they have grown up with these tools just the way the prior generation, my daughters are 23, they grew up in a mobile environment. This next generation is going to grow up with AI skills. And so I tend to be an optimist. We have our history in humanity has been that we have found new opportunities for people, new jobs, new creation of companies, new opportunities in terms of leveraging new skill sets. And I really think AI is going to do that. So I am not on the pessimist, everyone's losing their job side of this.
It's important context, too. I mean, technology advances. It's the transition period that might be a little bit uncomfortable.
It's always a little bumpy during the transition period.
Absolutely. So we could spend hours talking about AI, but I want to talk about some of the other hot topics, and that leads me to tariffs. Of course, you sit on many boards, as we mentioned, really spanning industries as well. So I wonder, you know, when it comes to tariffs, when it comes to supply chains, how is that affecting beverage? How is that affecting apparel? And how does that differ from, you know, maybe an entertainment and film company?
Sure. So if you think about, I'll take supply chains and tariffs as sort of two but commingling topics. Supply chains were really tested during COVID, and many companies had to rethink either the dependence, too dependent on China, needed to diversify, bring things onshore. So a lot of the supply chain work is ongoing, but a lot has been improved since the COVID era. Tariffs have been a moving target for companies, and there has been a lot of scenario planning, which the boards review to understand what the impact of the tariffs could be. I think we are very hopeful in the companies that I represent that once the details of what the impact might be are understood by the White House, which has been, you know, very open hearing from business leaders, which I think is a net positive. Once those cases are made about what the impact could be, particularly not just on companies that are based here in the U.S., but also on the end consumer, because the consumer can't absorb all of the additional costs from tariffs. Somebody needs to absorb them. So we are hopeful that some of the initial headlines, which may be shock to companies, a lot of that tends to calm down and find its way to be a more normalized rate.
Carolyn, I'm also curious, too. I mean, another big issue that boards are having to grapple with right now is the idea of succession planning. You sit on the board of Disney. There's been a lot of speculation about the replacement for Bob Iger. There was a story, you're not on the board of Apple, but there was a story the other day about planning for the successor to Tim Cook, who's been in that seat for a long time. What do those conversations look like?
So CEO succession is one of the most important jobs. In many cases, people would argue it's the most important job of a board of directors. And what I can say about it more broadly is you have to run an extremely thorough process. And this is my first time going through it at the Walt Disney Company, and I can assure you and everyone that the process is extremely thorough. It's been ongoing and very, very thorough, and our timing is early 2026, which we've told the market. But I think we have seen examples of some excellent succession planning. James Gorman, for example, led a tremendous succession at Morgan Stanley. He is our lead director at the Walt Disney Company. We just heard from Walmart, John Fernan stepping in, outstanding executive, and Doug has had a tremendous career there. So it can be done, and it can be done very, very well. But the boards need to take their role and responsibility extremely seriously, looking at a broad swath of candidates, internal and external.
And I know you can't speak directly to what's going on with Iger, but I am curious, overall, how much input does the existing CEO have in that transition planning?
This is the responsibility of the board for all the companies that I sit on. Of course, you know, the CEOs that are in any of the companies that I serve on always have input in terms of their, specifically if it's of somebody on the management team or multiple people on the management team. But we do that in the course of talent planning. We don't just look for CEO successions. For example, I run the talent and compensation committee at the Coca-Cola company, and we look at succession not just at the CEO level, at the executive leadership team, and we often go at least one click below. It's very important for boards to really meet numerous members of the management team and click one or two levels below to understand the up-and-coming talent.
Carolyn, really appreciate it.
Thank you. Thank you for having me.
Carolyn Everson there, of course, on the board of Coca-Cola and Disney and senior advisor over at Permira. We'll be back in a moment. All right, a big part of the downdraft in the broader market was when Home Depot early this morning cut its full-year earnings guidance. Those shares now having their worst day since 2023. Norah, Mulinda, our Bloomberg's markets correspondent, joins us right now for our stock of the hour. Home Depot, 6% drop today, and it doesn't look good here going forward.
Doesn't look good at all. And of course, a lot of this is hinging on the consumer discretionary items here. We're not seeing a lot of people coming out getting the big ticket items. If you think about potentially remodeling a kitchen or a bathroom or the floor layout in your home, we're not really seeing people doing that. While we are at a point where mortgage rates are lower than they were just a year ago, you are still seeing the consumer pressure during this time period, though it is important to note Home Depot tends to sway toward the professionals here, whereas Lowe's, of course, is more catered toward the DIYers.
But even still, and we only have about 30 seconds left, you do see Lowe's down about 2.4% right now, so traders a little bit nervous ahead of that report.
Absolutely, people are nervous, and of course we are going to be hearing from a lot of the other consumer-oriented companies tomorrow. You called out Lowe's, but then also we're going to hear from Target, Walmart, a few of those others, so that'll give us a broader read here on the consumer and what it means for the economy right now.
Absolutely. A lot to look forward to. Great reporting, as always. That is our markets correspondent, Norah, Mulinda. It's not all about Nvidia, Romaine. We also have all these consumer-facing names.
That actually scares me, though, because remember when it was all about Nvidia, it was all good times, and now we have to pay attention to the real economy, Katie.
Feels like a long time
Not just
ago.
the robots.
That's
you cannot
true.
put robots on your feet.
Yeah, no, that's true. You need socks.
Actually,
Coming
I
up.
did put robots on my feet over at Nike.
That sounds painful. Closing
It was
bell.
actually pretty fun.
Is up next. This is the close.
The last data point the market really had were comments by the Fed chairman. It took the certainty of a cut in December off the table. It now becomes very data dependent. And the data that really matters is the labor market. And from that point of view, I think we will get some guidance as to what December might hold.
Haigh, who joined us a little bit earlier over at Goldman Sachs Asset Management to kick us off to the close. And I think really getting to that salient point right now about how the market is really trying to figure out the next direction, not only for prices, but obviously for what the Fed does.
Yeah, absolutely. You take a look at the state of play right now, and it's not too pretty. The S&P 500, again, off its worst levels of the session, but still another down day. If it closes in the red, which it looks like it's going to, that will be your longest losing streak since August. And it's big tech that's the culprit, Romaine.
Big tech is the culprit, but as you were kind of alluding to earlier, we're now starting to see people really focus in on some of these consumer earnings, particularly with the Home Depot report we got this morning. Tomorrow we get Lowe's, Target, Walmart's going to be in the mix, a couple others I'm forgetting as well. And it kind of gets to this idea of what's really going to be more important for this market.
Yeah, absolutely. And if those come in, you know, without any sort of blemishes, how does that stack up against Nvidia? That, of course, is the big risk event of the week, I would say.
All right, well, let's bring Erin Gibbs into the conversation, Chief Equity Strategist over at Slatestone Wealth. She joins us here in Studio 2 to count us down to the closing bells. And that really is the big question, Erin. I mean, what is going to be most important this week for the market? Nvidia earnings or all of these earnings that we're getting out of the retailers?
I think it really has to be Nvidia. Just when you look at the sheer market cap of Nvidia, I mean, it's if you add up utilities, materials, real estate, they don't even add up to the same market cap as Nvidia. So globally, in fact, it's even bigger than industrial sector.
Yeah.
So it has so much impact on the broad market as well as globally that it's just something that you absolutely cannot ignore, and I think is certainly going to be more important than consumer discretionary.
What do you make of this idea when you start to hear people reevaluating the AI trade? Daniel Pinto saying AI needs a reassessment, a big downgrade at Redburn today on Microsoft and Amazon, and a lot of people now who seem relatively bullish just, I don't know, even a few weeks ago, now seem to be saying, wait a minute, how far have we gone?
Right. I think a lot of those conversations have started, and I was warning this beforehand, is when we started to see accounting changes and then an increasing level of debt. Now, nothing like the dot-com bubble, and I don't want to do any comparisons to it's not the same thing, but the fact that we're seeing a shift in your capitalization, that you're using debt more to fund this, and that also you're changing your depreciation rates. You know, like as soon as you start talking about accounting changes and debt levels, that's something that we need to say, okay, well, your valuations were sky high when you were purely cash positive and you had, you know, very aggressive comps. But now that you're starting to change the books, we want to pull those valuations back down. And I think that's a really important component of this pullback.
Well, it feels like, to your point, we're starting to see that re-rating happen in real time. But I want to talk a little bit more about the consumer because the conversation we keep having is that you think about price levels, maybe they're not increasing to the same degree as they were, but they're still much higher than they were just a couple of years ago. But when you think about 2026 and you wrap in monetary policy, what the Fed's going to be doing, and what's going to happen on the fiscal side, How does that set up the consumer?
So looking at the consumer is actually very interesting because of the tax cuts that are coming through in 2026. We expect refunds to be significantly bigger, adding somewhere between 240 to 280 billion between businesses and individuals. And I think particularly important on the individual side, we're looking at a tax refund average go from about $2,200 to $3,200. So a 40% increase, like an extra grand in your pocket. And we know that consumers like to spend their refunds. They don't put them in their savings account. They go out and spend them. So I think in the first half of the year, as we see those refund checks hit, that we are going to see a nice bump in consumer discretionary. And I think now is really a good time to get into them so that you get the full value as we go into the first half of 2026.
Well, let's talk about that a little bit more, how you translate this into a portfolio. What are some of the names that stick out to you that could benefit from some of those tailwinds you see coming?
Right. So some of that little bonus extra spend money, two of my favorites that have great fundamental stories anyway, are Ralph Lauren and Signet Jewelers.
Okay.
Well, Ralph Lauren is really unique. It's had a great run. It's really unique in that it straddles aspirational as well as affordable because it has those multiple layers of brands. They also have excellent growth in China. So they're just a great story fundamentally. And if you add in this little extra consumer splurge in 2026, I think it'll be poised very well. Another one I really like is Signet Jewelers. They've really been ramping up about pulling back from malls and doing more online. And they have some really strong brands like James Allen and Blue Nile. So as consumers are starting to get more comfortable with buying jewelry online, they really have been at the forefront. And you would think that we wouldn't be talking about companies pulling away from malls and omni-channel in this day and age. Like, welcome to the game, guys. This has been going on for many years. But jewelry has been a little slow to adopt this, and now they are. And we're seeing that growth go with that.
It was funny on the jewelry thing, because we were having this conversation in the newsroom a couple weeks ago when we were talking about kind of the future of malls and stuff. But I thought the jewelry stores were kind of dependent on those walk-ins to a certain extent, because otherwise, how often do you buy jewelry for, a birthday or a wedding or something? It's not, you don't necessarily get that impulse buying online.
Right. So bridal is still very key, but that you don't really see that growth. And we know, less people are getting married. It's just that isn't your growth area. What is your individual purchases, the jewelry that you want to buy for yourself. Exactly. And so that people are much more willing to just go online, get a great deal, and buy. Another shift they've done is
I want a pinky ring, but my wife refuses to let me have one.
I could see
She says she can't be married to anyone with a pinky ring. So there goes.
All right. Well, you're holding back on that sale. I mean, who knows? Maybe you should just the right one.
Sorry, I broke your train of thought there.
No,
You also like gamblers, right?
Yes, those are online gambling. Also, another area where people splurge. So just a lot of opportunities within the consumer space that we could see. And look, it's partially about having good fundamental stories anyway, not just relying on what we're going to see, but I think we're going to get that extra push, and we're really going to see some of those players outperform in 2026.
All right, Erin, great stuff here. I got to talk to what Katie's jewelry preferences are. Erin Gibbs, Chief Equity Strategist at Slatestone Wealth, helping us count you down to those closing bills. And Katie, we got to check the markets here, because a few hours ago, it looked like this was going to be an awful day. You basically had every indice deep in the red. We're off the lows of the day, and you even have a few bright spots. The Russell 2000, S&P mid-caps, Dow Transports, and the S&P Equal Weight in the green. What does that tell you?
There's certainly some places to hide, but then you take a look at the S&P 500. It's not as terrible as it could have been, but it's still not too good. The S&P 500.
Oh, so you're a glass half empty kind of
at
person.
least on this
I thought
day,
I was
apparently.
a glass half empty
Yeah,
person
we're
on this
switching
show.
roles here. I do think it's interesting that you take a look at the makeup of this sell-off. You actually have more names in the S&P 500 that are gaining right now than are losing, but it's the most important ones that are moving to the downside: Nvidia, Microsoft, Amazon.
Absolutely, and a lot of people keeping an eye on those key technical levels as we break down everything that happened in the markets today, and of course a big day tomorrow that comes up now in our simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld taking you through to that closing bell with a global simulcast. It starts now. Carol Massar, Tim Stenovic join us from the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A very consequential day in markets. on a very consequential week. A big focus on earnings, a big focus on geopolitics in Washington, and of course, a big focus right now on the state of the economy.
You know, and I was just thinking, I actually have a pinky ring for
What?
you,
Do you?
Romaine, in case you're interested in buying, you know, consumer spending.
Oh, I thought it was a gift.
Our audience has no idea why you're bringing that up.
No, I thought you were just talking about a pinky ring. Were you not on air?
How did you listen to that? Because we're, you on air?
We have our peeps, aka Finley.
Your sources, I see.
Listen, I do feel like 24 hours from now, right, we're going to be all over Nvidia. That's a big one. Do we just get a confirmation, a rehash of everything we heard from their big event in Washington, D.C. recently, or do we get something more that is more supportive of the AI spend? We will
for the market's sake, I think we need more, right?
Well, or maybe we need some of the fluff to come out. We've had quite a bounce back. Some would say a little bit of a normal correction or a normal.
See my crooked smile.
The NASDAQ composite, or NASDAQ 100 down about 1.2%. Earlier in the session, it was down as much as 2%. So I thought the tone, of today's trade, I thought was going to be a lot more negative. It's still, don't get me wrong, negative, but things could have been a lot worse earlier in the session.
Yeah, you definitely saw a little bit of dip buying here on this day, but still a lot of trepidation about where we go next. And as Carol says, a bit of a holding pattern until we see what Nvidia has to say about 24 hours from now. Meanwhile, in the here and now, 4 p.m. in New York, we get the closing bells and we get the clapping. I assume that's obligatory, even on a down day like today, with the Dow Jones Industrial Average closing lower by roughly 500 points, or about 1%. The S&P down about 55 points, or 0.8%. The NASDAQ Composite down 1.2%. And we should point out, all of those indices right now, not only below the 50-day moving averages, but now within reach of testing the 100-day moving averages. One of the few bright spots there on the day, though, was a Russell 2000 up about 7 points, or 0.3%.
Yeah, really fascinating. Back to the big caps, large caps in the S&P 500. At the close, a little bit more negative and kind of an even split here, guys. 250 names, Katie, to the upside, 253 to the downside.
Wow.
Yeah, almost even.
Almost even. Pretty dang close. Same thing, too, when you take a look at the circle here. You had 6 sectors finish in the green, 5 in the red, but take a look at what is red on that pie. Information technology, that was your biggest points loser on the day. That's why we had such a negative day in the markets. In terms of what did well, healthcare, energy, communication services, consumer staples as well. But again, tech, consumer discretionary, and industrials, the biggest weights, Carol.
All right, you mentioned healthcare, and kind of I'm looking at the medical space here as really a top performer in today's session. In fact, the number one gainer in the S&P 500, Medtronic, ticker MDT, that stock finishing with a gain of 4.6%. We did see it up the most in 5 years, its highest intraday in about 3.5 years. The news, the medical device maker lifted the bottom end of its range for adjusted profit forecast for the year. Company also boosted its organic revenue outlook following better than expected results in the second quarter. As I said, I just want to clarify, up the most in 5 years and its highest intraday in about 3.5 years. So anyway, some outperformance, not a name that we talk about on a regular basis. Merck, also an outperformer here. This one up about 3.9% in today's session. The drug maker said a mid-stage trial of its drug for a rare form of high blood pressure met its main goal. So analysts see this as a win, a trial win, as a potential for an expanded market for its drug Winrevair. Stock, though, still down about 2% year to date. And then I just want to mention strategy, because this one up about 5.8%. I'm not exactly sure why. Bitcoin has fallen so much, about 30% from its 2025 peak. So we did have a story in the Bloomberg, a rare euro-denominated preferred stock offered by Michael Saylor's Bitcoin treasury company has fallen below its offer price. I don't know. I'm not quite sure why
Bitcoin bounced off its recent lows today, so maybe that had something to do with it. I don't know.
Yeah, and you're also talking about a stock that's down, 37% in the past 6 weeks, so that could have something to do with it too.
Thank you, guys. Thank you for the
Sure
assist.
thing.
It's a group effort.
Glad we can help.
I will give you a pinky ring now.
Okay, thank you.
All right, let's talk about what's going on the downside. Stocks in the red today. Nvidia shares falling 2.8%, down for another day. The company, of course, reporting after the bell tomorrow, just after 4 o'clock. We'll have special coverage in those results live as soon as we get them. Shares falling as much as 3.7% earlier in the session. They're now down 12.4% from those all-time highs back in October. We should note, too, Microsoft, along with Nvidia, committing to invest up to a combined $15 billion in Anthropic. That's a move that ties Anthropic, which makes Claude closer to two of the biggest backers for its rival, OpenAI, which of course makes ChatGPT. In tech, also today, Amazon shares fell 4.4%. Microsoft closed out the day 2.8% to the downside. These companies saw their ratings cut to neutral from buy on Tuesday as Rothschild & Co. Redburn's Alexander Heisel downgraded the stocks for the first time since initiating coverage back in June 2022. He writes that the industry's, quote, trust us, Gen AI is just like the early cloud 1.0 narrative looks increasingly misplaced. He stated that underlying economics are, quote, far weaker than assumed. And finally, Home Depot shares falling 6% today. The company cut its full-year earnings guidance. It warned that some unsteady consumers are hitting the pause button on big-ticket home purchases. We're going to get more numbers tomorrow. We'll get Target, we'll get Lowe's, we'll get Williams-Sonoma, we'll get TJX, we'll get Walmart later this week, so we'll get a better idea of what the consumer is doing, seeing if this is more of a one-off or if this is something bigger.
Well, just an honorable mention, I was keeping an eye on shares of Klarna. They finished down more than 9% on the day, worst day since they went public just a few months ago. And the idea that they're setting aside a lot more money, Tim, for potential credit losses, that seemed to rattle a lot of folks. And when you start to talk about consumer spending, it's not always just about whether people want to spend, but also the idea that if you have a more holistic environment where things are deteriorating, does that then become a factor with regards to people continuing to spend?
Yeah, I feel like these buy now, pay later, you think that just because these companies are busy, it's a good sign, but it in terms of for them, but what it says about the economy and maybe consumers feeling a little bit
like what are people paying later for? That's the big question.
Yeah.
And are they paying later?
Yeah.
Right.
Yeah, and these are some of the things that, of course, the Fed is going to have to debate at its meeting in about 3 weeks. And you take a look at where yields went today, and I think it really shows you kind of the breakdown, I think, in bets and exactly which direction the Fed would go. We should point out that the implied probability on the Bloomberg terminal of a rate cut in December is still under 50%. But when you consider some of the deterioration we've seen in labor market data, maybe some of the deterioration that we're seeing in some of the consumer company earnings, maybe that changes what exactly the Fed has to do when they meet in 3 weeks.
All right, guys, let's get to some stories that are certainly on our radar here. We've been focusing, I'm sure you guys too, out of the nation's capital, the White House, President Trump's meeting with MBS, Mohammed bin Salman. Okay. Well, what?
I thought you were going for the other story out of Washington.
Oh, okay. Sorry.
This is a market show, Carolyn.
I know. I'm trying to keep it, family show.
Right.
Hey, having said that, the Trump Organization planning a luxury resort in the Maldives with a Saudi Arabian partner and plans to tokenize the hotel development project.
That sounds interesting.
It's the Trump International Hotel Maldives. It'll include 80 ultra-luxury beach and overwater villas. It'll be built with Dar Global PLC, the two companies said in a joint statement on Monday. It'll also mark the launch of the world's first tokenized hotel development tied to the project.
It's very dark outside behind you right now, Tim.
Yeah, that tends to happen this time of year.
4 p.m.
If you actually go to the southern hemisphere, it's light and warm this time of year.
Did you have nothing to share on our story?
Absolutely not.
I can tell.
I don't know
All right, Katie, over to you.
In this
Godspeed
sense,
for all you investors in
means, I guess,
tokenized Maldives, Saudi Arabian-backed.
You can buy digital shares,
resort,
perhaps, in the form of tokens.
Yeah.
Sounds exciting to a certain type of investor. Let's talk a little bit about Topgolf.
Someone will make money off
golf.
Sure.
Romain, sitting to my right, does. Apparently, Topgolf has agreed to sell a 60% stake in Topgolf and Top Tracer businesses to Leonard Green and Partners. That is a LA private equity firm.
All I have to say, I just hope they don't mess this up. This is actually, Topgolf is really kind of one of the big success stories. When you think about kind of what they did and the kind of gamification of a game, but the idea that just made it a lot more accessible. It's fun. You can take everybody there. Doesn't matter your skill level. And of course, we know whenever private equity gets involved in something, we got.
That's the thing. If you're trying to get into golf, it's a little bit of a chew. Really, the only intermediate step is mini golf, which I understand is not very close to the actual game.
Not at all, Katie Greifel. Do you golf?
No, not much of a
What about you,
golfer.
Carol? Carol doesn't.
No, but my dad was a big golfer. My brother.
Obviously, I'm not a golfer.
Okay, all right.
Obviously.
So this is the wrong crowd to talk to. Yes.
Oh,
and a great one too.
Loves to hit the links.
Like 110? What's your score?
110? How dare you?
He's well under.
I'm like 18. I'm like 18 handicap. There you go.
Wow.
Not to brag.
All right.
And that's with the full-time
Where do you have the
job.
time? Where do you have the time to do that, Romain?
That's what I'm saying. With full-time job, family. Imagine if I get laid off. I'll be on the PGA Tour.
Don't say that.
That's like Steve Cohen's big bet that we'll become so much more productive in the coming years that we'll have more time to play golf.
That is.
Will we have money to do that? Because that's why we work.
Yeah.
All right.
You need jobs.
We got to wrap.
To pay for that.
Our cross-platform. Shh.
Have you seen the green
Radio,
screens these
TV,
days?
YouTube, Bloomberg Originals. I hear nothing. Katie and Romaine continuing there on the close. Tim and I continuing right here on Bloomberg Business Week Daily. We'll see you again, folks. Same time, same place tomorrow.
And our coverage continues here on Bloomberg Television, but we're not done with our markets coverage here on this Tuesday afternoon. A conversation about the broader concerns related to the AI trade. Ed Yardeni going to be joining us in just a second. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. Another wild day on Wall Street. It started off with the big drop in stocks across the board. We were looking at 1, 2 to 2 percentage point declines for most of the major indices. The dip buyers did come back in late in the afternoon, helping to alleviate some of the worst case scenarios. The S&P 500, though, did still close lower for a fourth straight day. So too did the Philadelphia Semiconductor Index. In fact, 28 of the 30 stocks in that index moved lower ahead of Nvidia's earnings report tomorrow. We're going to talk about that in just a second. But keep an eye on the VIX, of course, a measure of expectations of future volatility. That closed above the 20 level for a second straight session. And Bitcoin trying to get its mojo back, but a bit of a scare earlier in the session with a break below 90,000 for the first time since April.
Absolutely. That will certainly wake you up. Let's talk a little bit more about the equity market, how it closed on the day at the single stock level. I start with Warner Brothers Discovery, up about 4%. We know we have a soft bidding deadline this week. You're going to see a lot of headline risk in the next couple of days. I actually want to go to the bottom, talk about Home Depot. We know that they reported earnings this morning. Did not go over too well. Home Depot shares down about 6%. And I end with Nvidia. Of course, the big report is coming tomorrow. You can see shares falling almost 3% in anticipation. And that's our top story this hour. Tech giants hammered, driving stocks to their longest slide since August. Now this, as JP Morgan Vice Chair Daniel Pinto warns AI valuations are due for a reassessment.
It's possible there is probably a correction there. And that correction will also create a correction in the rest of the segments in the S&P and in the industry, because you are probably, in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing.
Now, Pinto's warning coming ahead of this week's main event, Romaine, that is Nvidia results due in just about 24 hours.
Absolutely. And his comments raise a lot of interesting questions here about how exactly should you be valuing these companies. Ed Yardeni joins us right now, President and Chief Investment Strategist at Yardeni Research, who knows a bit or two about valuing equities. And I do want to start there, Ed, because the narrative for much of the year was this idea that when you looked at some of these sky-high valuations on these chip stocks and tech stocks in the AI space, the idea that you were buying not just into future earnings, but really a future transformation of industries overall, and that justified the price that a lot of people had to pay. Has something changed?
Well, look, the Magnificent Seven have been magnificent for a while. ChatGPT was introduced in November of 2022. These Magnificent Seven stocks have been doing quite well even before that. In addition, the other thing to keep in mind is data centers are not exactly a new development. It's not like they all just started to build data centers this year. Data centers have been around ever since the internet became the cloud, and then the cloud is where all the data centers really come in, and that started really around 2011, 12, 13, 14. So there are plenty of data centers, and they've got lots of old chips, and many of them are still operating. So I think that this whole debate is a bit of an exaggeration in terms of comparing it to the tech wreck of 1999, 2000.
And I've heard this argument, too, also the idea that even if a lot of those data centers don't get used specifically for some of that high-powered AI stuff that we've all been talking about, that there's a lot of other uses for them. But, of course, that doesn't mean that all these companies are going to benefit from that. Certainly the hyperscalers and, to a certain extent, I assume the chip makers. But when you start going down the ladder, Ed, as to what's been driving this market and how narrow that participation has been, is there a broader concern that we should have out there that if we don't see those stocks hold up, that the rest of the market basically has nothing to offer?
Well, I think it does have something to offer. It has very good earnings. Everybody seems to be under the impression that the only companies that have any earnings growth whatsoever is the Magnificent Seven. That's not true at all. The rest of the market's been doing well. Just by comparison, not as well. In other words, if you take out the Magnificent Seven and just say they don't even exist, I think we're still in a bull market. I think we still would have had a bull market. Look, this AI evolution in the digital revolution is going to continue. The fact of the matter is that there's no shortage of data. And what we're seeing is that in this digital revolution, the more data we can process, the faster we can do it, the more cheaply we can do it, the more data we're going to process. It feeds on itself. And so I think a lot of companies right now are testing out AI models. I think that in itself creates a lot of demand for AI capacity. And then I'm a believer that at the end of the day, there'll be lots of applications for AI, not to do kind of state-of-the-art kind of research, but certainly do some of the more mundane things that are done by entry-level employees. So I think it's going to be a big productivity booster. I think it already is. I use it all day, and I can't say that I completely trust it. I double-check everything it does, but it's kind of like Google search on speed and steroids. Right. It's wicked fast.
Yeah, and you're certainly not alone in using AI all day. Not me personally, but I know many folks who do. And I also want to bring this conversation, what we're talking about, these themes, and talk about it in the context of what's going on in the credit markets as well, because you're kind of seeing these questions really percolate in a big way when it comes to equities. But then you take a look at investment grade debt, you take a look at high yield debt as well. Risk premiums starting to rise a little bit here, even with spreads so tight. And I wonder, is it the same conversation that we should be having when it comes to the debt markets?
Well, I think it's very healthy that everybody's so jittery. On the equity markets, everybody's paranoid about 1999, 2000. In the credit market, everybody's paranoid about 2008. And I think worry and climbing a wall of worry is probably what these markets are going to do. Look, the reality is the private credit markets have become very, very large. And portfolios that own private credit own diversified assets of loans. So if a few of them blow up, if a lot of them blow up, it's going to be a major hit to rate of return. It may be a haircut or a major hit to a rate of return. I don't think it has any implications for the banking system generally. I don't think it causes a credit crunch. Maybe credits are viewed more carefully. But all in all, I don't see it adding up to a credit crunch that causes a recession.
All right, Ed, great to get some time with you, especially on a day like this one. That is Ed Yardeni. Sure. He is President and Chief Investment Strategist over at Yardeni Research. And I do want to bring us some breaking news here. Constellation getting a $1 billion loan to open 3 Mile Island. This, according to reporting, of course, we're talking about the nuclear plant, Romain.
Absolutely, and this gets to the idea here of the big AI data center build out and the hungry power needs that it needs on that front as well. On semiconductor, those shares spiking about 8% in the after hours trade, now only up about 5% here after announcing a $6 billion share buyback authorization. So to a certain extent, for all the concerns out there right now about cracks in the AI trade, at least for right now, it seems to still carry on, though we'll find out whether there is some real staying power to that in about 24 hours.
Yeah, just 24 hours to go. Of course, we're going to continue to follow these stories as well. This is The Close on Bloomberg. Well, a December Fed rate cut might be underestimated. That's at least according to strategists over at Goldman Sachs. The team joining Barclays and Bank of America in betting the economic data delayed by the shutdown will revive the case to cut, writing, quote, reductions in near-term cut pricing and lower front-end inflation through the course of the shutdown reflect a hawkish shift in the market's Fed assessment. Let's discuss with Monica Guerra. She is head of U.S. policy over at Morgan Stanley Wealth Management, joining us now. Monica, great to see you.
Great to see you.
So let's talk about it. We're finally out of the longest shutdown in history. We're starting to get a drip feed of these super delayed economic data releases. And I just wonder, how much faith investors can have in, of course, what we're talking about when it comes to data, but also what it means, the fact that we did have this shutdown, so to speak.
Yeah, I mean, the delayed data piece is important. You know, folks are trying to cobble together, right, the best framework that they can, and it could influence the December Fed decision. We don't know how much, right? We have to wait and see what actually happens there. You know, we do expect a cut. We are in that camp. But when we're thinking about the broader picture, we're advising, our clients to, not just look at the data that's released, but also look to alternative sources as well.
Mm-hmm. Alternative sources as well. That is one of the conversations we had over the past 40-something days of how complete of a picture can you put together when you think about the alternative data, how it actually tends to stack up against official government data.
So I'm not the economist in our office, but what I can say is that if we're thinking about interest rates and what matters, right, for our clients and individuals, we have to watch that balance between the labor market, inflation, right, and what eventually the Fed is going to do. And so that's really what's on the top of the mind for the people that we're interacting with every single day and that we're trying to walk through, right, some of those uncertainties.
With regards to those uncertainties, I think it would be an understatement to say that things have been a little dysfunctional in Washington for some time, certainly this year, but even prior to that. But when people start to talk about, we're going to get another credit rating downgrade on the U.S., blah, 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 is that in the realm of possibility, or is that just kind of folks just pontificating?
I mean, anything's in the realm of possibility, but we just received
plausible?
an affirmation.
Yeah.
We just got an affirmation from S&P, AA+, stable outlook, and that's predicated on tariff revenues. So that's a very different environment. So even though we have this massive addition to federal debt and deficit with that 4.5 trillion from the OBBBA, the important thing here is what happens with tariff revenue. And we think it's here to stay. So we think that the risk of any sort of downgrade is much lower because the Trump administration is already doing the legwork to get ahead of a Supreme Court decision on tariffs.
Well, I mean, how do you do that, though? I mean, if there is a Supreme Court decision and then those tariffs, and I'm always confused about the use of the word revenue, that just goes back to the original source, right? Is that a net positive for us all?
Well, potentially,
Yeah.
and it isn't from the consumer perspective, that'd be very hard to track down, right?
Oh, okay.
Really, it would go to the businesses if they did have any sort of reimbursement.
Yeah.
But what's most important about this is that you have the administration clearly working on bilateral trade deals, which do not qualify under IEEPA and would be a separate thing, essentially replacing those IEEPA revenues, as well as the use of Section 232, 301, and many others. So for us, we think that this is a patchwork approach, and you don't get necessarily the broad sweeping impact of IEEPA of saying Emergency Powers Act, great headline, but you get to the same place from a revenue standpoint. Maybe a little less, maybe you're more 2 trillion versus 2.5 to 3.5, but you're still in a place where the ratings agencies, the credit, analysts are feeling comfortable.
But even so, I mean, you talk about that patchwork approach. Maybe the IEEPA tariffs are ruled illegal. Some of those other avenues, the timelines are drawn out a little bit longer than just IEEPA. So let's go into hypothetical land. Let's say that, you're not able to get the revenue streams that are at least anticipated right now. How does that translate into the market? Should at least the IEEPA tariffs get ruled illegal?
Well, in that instance, if you don't have this sort of very quick replacement, theory, if you're looking at delays, that's going to add to bond term premiums, right? Essentially, the risk that you're getting compensated for holding a treasury. So for us, this is, potentially some interim bond market volatility, but essentially the administration is likely to signal what they're working on. They're already doing that. They're already conducting studies around Section 232. And so the one thing that's really amazing about this administration as opposed to others is that they tell us everything that they're doing. And so markets can either look through it, they can wait. It has multiple implications when we're thinking about business cycle and decision making, but especially from a bond market perspective, it's a priority for them, and they're likely to signal very strongly the direction in which they're moving.
All right, Monica Guerra, head of U.S. policy at Morgan Stanley Wealth Management. When we come back, a special conversation that we had to catch up with legendary sports agent Rich Paul. He talks a lot about the business of sports, and more importantly, the business of sports apparel, his new partnership with New Balance, and how he's positioning his Klutch Sports Group for the future. That conversation when we come back after the break, right here on Bloomberg. The legendary sports agent behind LeBron James' slam dunk of a career is making a foray into athleisure. Rich Paul is the founder and CEO of Klutch Sports Group and a board member at UTA. He's teamed up with New Balance to promote his Klutch Athletics brand, an athlete-first line with community at its core. With his third New Balance shoe out in stores in the first week of December, I had a chance to catch up with Rich. He talked about his beginnings out there in Cleveland and his big projects ahead for the future.
Well, with Klutch Athletics, my thought process was really just focus on community, giving that voice back to the consumer. When I was growing up, that's where I learned how to really build my confidence and style and deciding what kind of fit me and the mantra I was trying to build as a young man. And so I found that being fun, going to the store and identifying the brand that I really align with authentically. And so when I looked at the marketplace, I seen a lot of things that was kind of taken out of the realm of the youth and community and the voice of the athlete and the voice of the consumer. And so felt like there was a world where, the next brand for kids to actually believe in could be us. So that's Klutch Athletics.
I'm curious about it, too. We've talked a lot on this show about some of the bigger legacy brands like Nike and Adidas, and the idea that you've had so many upstart brands really make an impact over the last few years, whether it's like Hoka and On in the running space and other sports as well. I saw you hired a long-time Nike executive to sort of help run things there. And I am curious as to how sort of a mega brand or a mega industry like Nike translates into a smaller upstart. Are there parallels?
Yeah, a guy like Scott Munson, I think that's who we're referring to coming on. He's been a game changer right away. It's hard to disregard the expertise that he has and the experience that he has. And so we felt that from day one. Look, the apparel business from a sports performance perspective is a very crowded space. It just is. And it's very hard to build a brand. Most companies really start to see a positive impact probably in about year 7. But we have a great partner in New Balance. We have an unbelievable team in terms of our leadership group. And so, just our focus now is just continuing to take baby steps. I think we have the right messaging in the community. I think we have the awareness in the community as well. And so now we have to make the product, and we have to have optionality, which we're focused on. Being in the right retail doors, the doors that tell your story in a very authentic way to your targeted consumer is important. And so these are all things that you have to learn. And so I've obviously, I've had some experience in this space myself, but I've surrounded myself with people that are way more experienced than I am in that space. And they have the expertise and the years of service. And so that's important.
How much does this link back to your own origins? I mean, everyone knows kind of the legendary story, whether it's accurate or not, of you kind of, cornering LeBron when you were selling your throwback jerseys, and that was kind of your bag at the time. Is there a parallel to that?
Yeah, look, I've always been someone as a young kid that I love sports, I love fashion. I was always someone that was really interested in that intersection of culture. And, that thing with LJ was just fate in the airport. Not much of a cornering, I know, but it was more so just like I had on something that he had saw just a few minutes ago, and it really struck his interest, and it just so happened I was in that space. Mm-hmm. But ultimately, everything goes back to sport. And as you see, even when the world stopped, it was sport that kept us going. When you talk about the brands that you named that's doing a really good job, again, their foundation is sport, whether it's running, whether it's training, whether it's basketball, whatever the case may be. And so I've always had a real passion for that. I've had, consistency across all sports in my involvement. I played every sport there was to play. And I was always a kid that really loved the detail and everything. When I bought shoes, when I bought clothes, I really looked at the detail, the messaging that was in it, and things that. And when I identified with brands, a lot of it came from the stories that was told. And if I didn't like the story, I didn't align with it, or if it didn't align with me, I didn't purchase. And so, my experience comes from a very authentic place. But we have to go out and do the work. And so it's something that I look forward to every day. And again, it ties back into everything I do. And so when people see me do all these things, I know it's like, how does he have the time? Well, they're all they're intertwined. They're all connected in a lot of ways. They're not all the same company by no stretch of the imagination, but its foundation, it all leads back to sport.
I am curious, do you plan to leverage your existing roster of athlete clients to maybe help with the build out of Klutch?
Klutch Athletics? No, not at all. You know, I think that you when you're a company of our size, which is very small today, you have to be very strategic about how you do things. We're focused on community. We're focused on that kid that is in community, that identifies with us, that can grow with us. You know, and there will be times where we touch the athlete. There will be times where we do activations in community and may align the athlete of whether they're on the Klutch Sports Group roster or whether, you know, if the other competitors can get past the name and really do what's best for the client. It could be another athlete that's on a different representation roster. Klutch Athletics is a standalone company. It's not. There's no one that worked at Klutch Sports Group that worked at Klutch Athletics. The name was just so good, and New Balance thought the name was just really good, and they wanted to keep it as such, and so we're fine with that. But no, we're really focused on community. Yeah. And going back to that, you know, that time to where representing that little small piece of grass that a kid first played his first game on or scored his first touchdown on, or that little, you know, that little basketball hoop that was made out of a crate that I used to play on, and you counting down to hitting those game-winning shots. And, you know, it's really just really focusing on that community where we live and play. So that's been something that we've been focused on. And, you know, look, I have this mentality that, and I'm living proof, the best come from anywhere. I'm living proof of that, right? And I'm not calling myself the best. What I'm saying is you don't have to come from certain places to be somebody. And so I want to make sure that, you know, our audience and our consumer understands that.
And that is Rich Paul, of course, the founder and CEO of the Klutch Sports Group, talking about his latest endeavor called Klutch Athletics, which is basically an athleisure brand that he's launching basically from the ground up. And he knows a lot about starting from the ground up. Basically got his start in the sports agent business, ran into LeBron James in the airport, basically tried to sell him a vintage jersey, Warren Moon jersey. They struck up a partnership, and now he represents hundreds of athletes across all the major sports.
Yeah, the rest is history. Going to be interesting to see how athleisure goes, because boy, that's a crowded space.
Yeah, it is, absolutely.
Yeah, one that I'm well versed in. But let's take a look at how markets closed on the day. Not too pretty. It could be worse, but still down 0.8% on the S&P 500. You take a look at the Philadelphia Semiconductor Index. Boy, what a wipeout, down 2.3% ahead of Nvidia earnings tomorrow. The VIX trading with a 24 handle, getting close to 25. A little bit of a bid coming back into Bitcoin. We'll see how sustainable that is. This is The Close on Bloomberg. Food inflation, a hot button issue ahead of Thanksgiving. And though many consumers continue to feel the pinch, our next guest says that ingredient costs are stable. Joining us now is Stew Leonard Jr. He is the president and CEO of Stew Leonard. So ingredient costs overall are stable, but everyone cares about the turkey. What are you seeing there, especially as we round up into, oh boy, and there's one.
That guy.
How much does that guy cost, and how does that compare to last year?
Well, this will probably be about close to a 20-pounder, and we're about $3 a pound right now. But one thing I recommend everybody, get a fresh turkey. This is from the Lehigh Valley in Pennsylvania. It's an award-winning turkey, and it's free range. So look, get a fresh turkey. If you can get it free range, no hormones, no antibiotics, don't waste your money on a frozen turkey. I saw them for 49 cents out there on special. Don't buy that turkey, okay?
Don't buy it. Okay.
That thing's been in a freezer for 6 months.
I will not buy that frozen turkey, and we appreciate the PSA. But you mentioned, of course, that turkey came from a local farm. So Give us a feel about how the farmers are feeling, because we talk about ingredient costs, but you consider labor costs, farm incomes. What are you seeing there in those conversations?
Every farmer I talk to, the first thing that comes out of their mouth is the cost of labor right now. It's going up, and we haven't raised our turkey price this year, but we had to negotiate that a little bit because our farmer wanted to raise his price. But we didn't want to, we wanted to keep the price the same. So his costs have gone up, his feed costs, his energy costs are, even here at our food stores, they've gone up substantially. So there's pressure on retailers and farmers today to contain the costs.
Stu, I am curious, though. I mean, when customers come into the store, particularly not just for the holiday season, but really over the last few months, we've been talking on the show a lot about how people are really concerned about prices, particularly food prices. When they're coming into the store, are they just looking for the things that are on sale, looking for the bargains? Are they still willing to pay for, I guess, the more luxury items, if you will, for lack of a better word?
Yeah, you know what? It's funny, but our prime steaks, the grade, it's up about 20% this year. It's like Haagen-Dazs ice cream is still up in sales. I think people right now, what we notice is they're not eating out at restaurants enough, and they want to come and cook it themselves. They can save a lot of money by making it themselves at home.
Is there a sense, though, I mean, that and when people come in, in fact, we were speaking yesterday with the CEO of Butterball, Jay Jandra, and he talked about this idea that for holidays, people are going to spend no matter what. They want their table to be full and bountiful, as I think most of us want to do. So do you get that sense that as people come in for the full table, not just the turkey, but all the accoutrements that go with it, it's still the same spend, more or less, that they would have done in previous years?
Yeah, it's pretty stable around here. You had great reduction in egg prices. Butter prices are down. Those are the big items at Thanksgiving right now. Most things are about the same price. The one thing that you're going to feel a little bit of pinch, here's one of our nice ribeye steak, Romaine. How would you like to put that on the grill tonight?
I would love, Stu, I would love to put that on the grill. I would love to put that fresh free-range turkey in the oven. I should also point out that I'm one of the few people in my family that eats meat. So if they're not eating turkey and they're not eating, prime rib and things like that, what other options are there out there?
Well, ham is big at Thanksgiving right now, to do a turkey and a ham. We sell a lot of smoked ham. One of the things we're noticing, the customer seems to be buying right now. I mean, they're the store's doing well, and we got the customers coming in. You hear ripples of people about the cost of food this year because it has gone up. I mean, the tariffs have obviously you got to build them in a little bit into your pricing. You can't eat them all. We're dealing with mostly small farms, not the big Kellogg's and Procter & Gamble's and stuff. We're dealing with small farms, and we don't want to hurt them, so we're splitting a lot of the tariffs with them.
Yeah.
In some instances, the importers have decided to eat the tariffs themselves and not bring it on to us, like in the case of bananas, for instance. But Trump just relaxed the tariffs. So I think you're going to see food costs stable. I could see them maybe coming down in the future if we can get this tariff situation in check right now.
Yeah, well said, Stu. Well, that's why we like talking to you. You always have a nice read here on not only your consumers, but of course everything that goes into supplying the food to them. And of course, love your personality. What's that?
Hey, Romaine, one thing I do this mashed potato index.
Okay.
Doesn't it make sense that we have mashed potatoes that our chefs make at like $4 a pound, and then you can buy a potato for $1 a pound? So when the economy's sort of tough, wouldn't you expect the whole potatoes to go up in sales?
I would think so.
And people mash them and make them at home, right?
Yeah.
It's not the case right now.
Okay.
Our mashed potatoes by our chefs are up in sale. So what does that tell you about the economy?
That's a good point, Stu. I mean, I guess people are willing to take in some of those luxuries, particularly for something like freshly made mashed potatoes. The mashed potatoes index. I wasn't expecting that, Stu. Always a pleasure talking to you, Stu. The man, the myth, the legend, Stew Leonard Jr., President and CEO. Happy Thanksgiving to you. All right, when we come back, we're going to talk to the musician, Miguel. He's out with his first studio album in almost a decade. He's also a scholar in residence at New York University trying to teach students about the music industry. That conversation coming up next here on The Close. This is Bloomberg. Miguel, the Grammy Award-winning recording artist behind the hit songs Adorn, Sure Thing, and All I Want Is You. He's out with his first studio album in almost a decade, titled Chaos. The album explores anger and angst and marks the start of his upcoming global tour that kicks off its North American leg in February. He joins us live in studio. We should point out he's also a scholar in residence at New York University, leading a curriculum tied to creative revival. What a pleasure to have you.
Man, I'm so happy to be here. Thanks for having me.
I mean, when I heard you were teaching a class at NYU, I thought this was perfect because I was thinking about when you came out, 2012-ish, 2013-ish with Adorn, and the music industry was always going through a big transition. But since then, it's been completely turned up on its head.
Absolutely.
And I am curious as to what the students ask you about the music industry, or at least what they want to know about how they can be in the music industry.
Yeah, the course that we designed for my residency at NYU is actually more about how artists across all mediums can be effective in this paradigm. So I get to answer questions about the music industry as well as questions about the film and TV industry across the fine art. I think it's really keying in on how important leverage is to really making any kind of change.
I'm curious then, I feel like in the old days, at least when I was a younger, artists of all types, you pretty much had to go through kind of these big corporations to be heard or be seen. And that's changed a lot. Obviously, the internet has democratized things a lot. Yeah. So you have people that have no ties to big business that can become big artists.
Exactly. Yeah. I think that's where the key is for all artists across anything. And I think we're seeing so much success come from people in their small niche. That there's plenty to learn from if you just pick up your phone. The truth is that there's a lot of antiquated systems that need updating, need upgrading, and we have the power and we have the ability to kind of leverage our audiences to make the systems work in our favor.
Well, talk to us about the influence of social media and how that can be used as a tool, because I'm in my 30s. I'm not exactly in high school, but even through TikTok, I feel like I've been introduced to a lot of new artists, a lot of new songs that I might not have found otherwise.
Valid, super valid. This is it. This is the biggest blessing, I think, for artists, for creators across all mediums, like we're saying. How you can do that is really about you figuring out what it is about your point of view, what it is about your interests that are uniquely yours. And I think rinsing and repeating. But I'm not a social media expert. That's not my thing at all. What I want to key in on in this course at NYU is how important community is and how important point of view is, how important really speaking about what we're seeing in the world, whatever it is that's important to each and every, to the artist. That's what I think keeps and honors the importance of art.
Right.
Art has the power to bring people together through emotionality and help us kind of see past the differences that we use to kind of are used to divide us. And I think that's where, if we look at history, we can use it to our advantage to really come together through art. Right. So as to change the systems in our favor.
Well, I'm really curious to hear your opinions on the influence that AI has had when it comes to the music industry, when it comes to art, because so far from what I've seen, there's a really passionate pushback against using AI to make art. But I wonder if you see any good that can come from that.
There's some technology has always been a part of creativity. I think as a human race, we are always looking for ways to optimize our time, make things easier, more efficient. Some things, have shown us the value of not taking the quick and easy route. But I think we'll always be using technology with art as we progress as a race. there are several projects where I think AI is used in a really interesting way. I was talking with one of my best friends earlier today about how AI is being used in choreography or with a choreographer and how they're using it to inform it. And it's beautiful. It's a modern art performance where she's playing off of AI. Really interesting ways to do this. The interesting part to me is that we're not using AI to solve bigger problems. We're using AI to figure out how to make money, you know, and how to answer, you know, it's as opposed to solve world hunger, you know what I mean? Or to figure out how we can make everybody play together in a better way to stop, you know, to catastrophes and to stop wars and people being taken advantage of. That's what I think is important. And in the course is called Speaking Chaos to Power. There's a little bit about how AI can be used to leverage community, again, to make the change that we want.
Well, Miguel, we have to leave it there. Really fascinating conversation.
Yeah.
Really appreciate your time. That is Grammy Award-winning artist and NYU Steinhardt Scholar in Residence, Miguel. Really interesting conversation, especially as it pertains to AI, which we talk about all the time, but maybe not through that lens.
Yeah, but he also makes a good point too. I have seen a lot of good uses. I mean, I have a 16-year-old, and he has found a lot of creative ways to use AI that doesn't, like, you know, destroy the world or anything like that. So there is some hope for us.
Yeah, there is some hope still. That's the message from the close.
That does it for us on the close. There's a lot going on in Washington today. You want to stick around. Joe Matthew and the team of Balance of Power coming up at the top of the hour with two of the biggest stories of the day out of the White House right here on Bloomberg.